This SEC filing released last week gives us a snapshot of Michael Burry's stock portfolio. It shows he sold every single share in 14 companies he previously owned, used the cash to double down on some of the ones that he decided to keep, and to invest in 5 brand new stocks. To most people, his portfolio might just look like a random assortment of businesses, but when you look a little deeper, there are some very distinct themes. Big investments in particular industries, countries, and even asset classes. So let's take a look at the Big Short Star's $200 million portfolio, a deep dive into the 16 stocks revealed by his latest US filing, and also a stock that isn't listed, one that's hidden in UK regulatory filings, a stock that's actually his biggest known position. But let's start with the clear outlier of the portfolio. For the first time, he invested in the Sprott Physical Gold Trust. As the name suggests, it's an ETF stock that allows you to invest in physical gold, of course, without the inconvenience of buying and storing it yourself. The value of Burry's gold investment is about $7.6 million, so at just under 4% of the portfolio, it's his 6th largest position. The trust holds about 3 million ounces of gold at the Royal Canadian Mint. Some gold ETFs that you can invest in will essentially just try and mimic the price of gold over time, whereas this one in particular gives you actual ownership of physical gold. In fact, you can redeem your shares for actual gold. There is a minimum, about $100,000 but you can exchange it. If, of course, you feel like storing 400 ounces of gold yourself. For us metric system folks, that's about 11.3 kilos. Gold is currently priced around $2,420 per ounce. If you've owned some, you've done pretty well. It's up about 90% in the last 5 years and 21% in the last 6 months. The strong performance of gold in the last few years is one of the reasons why a lot of people are attracted to invest in it. The Sprott fact sheet actually shows that gold has even outperformed the US stock market since 1999, which is true, technically, but it's also a little misleading. The starting point they chose just happens to be the peak of the internet bubble. If we measured the performance of gold versus the stock market from the bottom of that crash, their returns are about the same. And we can't forget the other important piece, the dividends. Gold doesn't do anything. It just sits there looking pretty. But businesses earn profits, and some of that is distributed to stockholders as dividends. So when you include dividends, the stock market has beaten gold by about 2% per year for 20 years. But hey, gold has done pretty well for investors over time, and it's been particularly valuable during times of crisis. When a recession hits or some kind of problem that challenges financial markets, stocks usually go down a lot, while on the other hand, gold usually goes up. But it's even more than that. The market for buying and selling gold has some very unique characteristics, and understanding them made it clear to me why Michael Burry didn't buy gold in 2022 or 2023, but in 2024. Why he's buying it right now, and provided an answer to the many questions raised from the warnings he's been giving in his Twitter posts. But before I get to that, I just want to pause the video quickly and talk about something that's really important to me and I know affects a lot of people, and that's mental health. And because of my experiences with dealing with mental health issues and the way I was able to overcome some of these with therapy, I've decided to partner with BetterHelp as the sponsor of this video. Almost all of my audience are men, and we in particular can have a tough time opening up to the people around us. I know this from personal experience. I've dealt with social anxiety, and at times it's made it difficult to maintain healthy relationships. It probably comes as no surprise to anyone, but I like solving problems on my own, but sometimes you just need to reach out for help, and therapy for me has been one of the best ways to do it. It's an anonymous space to talk through your mindset and thoughts, and I think the most valuable thing for me was hearing new perspectives on what I was going through. If you're struggling with something in your life, maybe it's anxiety or depression, know that seeking help is a sign of strength, not weakness. And that's where BetterHelp comes in. They offer online therapy with a wide network of licensed therapists who specialize in different areas so you can find the right fit for your needs. With BetterHelp, you can communicate through voice chats, phone calls, or even messaging. Plus, you can easily switch to a new therapist at no additional cost. BetterHelp is making therapy more accessible and convenient than ever before. So if you're interested in giving online therapy a try, go to betterhelp.com/Hamish Hodder or select select Hamish Hodder at sign up for a special discount off your first month. Investing in your mental health is one of the best things you can do, so don't be afraid to reach out for support. To understand Burry's gold thesis, we need to understand the factors that influence its price, which in the case of a commodity like gold is looking at the key supply and demand factors. Let's start with the supply side. Obviously, if we hold all else equal, the more gold that exists, the less valuable it is per ounce. Best estimates currently suggest that about 212,000 tons of gold has been mined throughout history. And on top of that, another 2,500 to 3,500 tons are mined each year. Under the ground gold that hasn't been mined yet is categorized as either reserve or resources, which is essentially saying whether it's either economically viable to mine it today or whether it's not. The US Geological Survey estimated that global reserves are currently about 50,000 tons. But while the supply of gold does increase every year and will do so for the foreseeable future, most of the supply of gold is already above ground, so price fluctuations in the price of gold are likely to be mostly influenced by buyers and sellers of above ground gold, or in other words, the demand for gold. About 45% of gold has been made into jewelry, and it's the largest source of annual demand. This has been declining somewhat in recent decades, but gold's durability and it being the least reactive to other metals make it a very desirable choice for luxury accessories. India and China are the biggest gold jewelry markets, accounting for about 50% of sales. The next 17% of gold is held by central banks around the world. Many countries keep some of their reserve assets in gold. The US, for example, has 8,000 tons of gold worth about $700 billion. These reserves, for the most part, don't change. The US hasn't bought or sold a meaningful amount for decades, and fast-growing economies like China have been big buyers of gold. The last category, besides the 15% held in the other category, is 22% held in bars and coins. This portion of gold includes people buying gold as a store of value, and relevant to us, it includes ETFs like the SPREADSHEET Trust, which Burry is invested in. It makes investor sentiment the last and maybe the most interesting aspect that influences the price of gold. Specifically, many investors view gold as a hedge against inflation. It's no secret that the US dollar has been declining in value, and it's actually been declining at an accelerating rate in the last 15 years. Take a look at the US money supply. It's been growing a lot recently, mostly due to quantitative easing practices by the Federal Reserve. If the US government needs to spend a lot of money quickly, like during the pandemic, the Fed effectively prints money and lends it to the government. And what does that mean? Well, there's just more dollars chasing the same amount of goods and services, so the prices of those goods and services goes up. But the same thing also happens to gold. There's more dollars chasing the same amount of gold, so its price also rises. So Burry buying gold likely means he wants to protect some of his fund's assets from the possibility of another spike of inflation. And he said exactly that in a tweet last year. He said, "Inflation has peaked, but it's not the last peak of this cycle. We're likely to see CPI lower, possibly negative in the second half of 2023, and the US in recession by any definition. Fed will cut and the government will stimulate, and we will have another inflation spike. It's not hard." The idea is that the US might face something similar to what happened in the US in the 1970s. Interest rates were raised and it slowed inflation, but dropping rates back down too soon led to inflation coming back just a few years later. Okay, but let's say that you were very confident that something like that was going to happen. How do we even know that gold is even a good inflation hedge? It does have a history of rising during periods of uncertainty, so you could argue for it being a hedge against an economic crisis of some sort, but against inflation specifically, maybe not. If gold was a really good US inflation hedge, then you'd expect the real price of gold to be somewhat constant over time, or put another way, the price of gold should rise a similar amount to how prices rise generally. That's not what we see. Gold has risen with the consumer price index, but it fluctuates around it a lot. In the 90s, gold actually didn't keep up with inflation, and in the last 15 years, it way outpaced inflation. Gold is a global commodity, so of course, its price is influenced by things other than the US dollar. But that also reduces its efficacy as a hedge. The last point I'll make on gold before we look at Burry's other investments is that at the end of the day, gold has no intrinsic value because it doesn't produce any cash flows. When you buy gold, you're simply hoping that someone else pays more for it than you did. And so if you do have gold in your portfolio, it's at most likely going to be a small percentage used as a hedge against economic uncertainty, or if that at all. The rest of your portfolio, like Michael Burry's, might contain businesses that produce a lot of cash flow, like Burry's biggest known position, which is in British American Tobacco. It's a UK listed business, so you actually won't find it on the US 13F SEC filing. And the investment is worth $10.5 million, or just over 5% of the portfolio. The company is the largest tobacco company in the world and is the owner of some of the biggest cigarette brands like Dunhill and Winfield. To offset the declining use of tobacco products, they've also built a large non-smoke business with vape brands like Vuse. Recently, they announced they're aiming for 50% of revenue to be from smokeless products by 2035. Since 2017, the stock has been a disaster. They've faced increased regulatory pressures, particularly from the FDA, and they've slashed their dividend, which investors were not too happy about. But the business, for the most part, has produced pretty stable revenues and profits in the last few years, and they're producing about £10 billion of free cash flow per year. The stock's enterprise value, which I kind of think of as the price of the whole business, is around £90 billion. So it's a cheap, stable business producing a ton of free cash flow, which is exactly what you would expect in most cases from Michael Burry. The next big theme in the portfolio is China. Burry's second and third biggest stocks are Alibaba and JD.com, which he also added to in the last quarter, and he now also owns Baidu. The e-commerce and internet-based companies have seen large stock declines in 2021. After benefiting from increased online shopping and manufacturing amid the 2020 pandemic, their profits have fallen quite sharply as their costs have risen. But in the last couple of years, things seem to be improving again. And once again, their shares are pretty cheap compared to current cash flows, a price to free cash flow of just 10 for Alibaba. To put that in perspective, Amazon's price to free cash flow is almost 42. JD is even more dramatic, a price to cash flow of just 6. The stock market is essentially pricing these stocks as if their profits are going to decline in a meaningful way over time. So if that doesn't happen, then Burry is likely going to do reasonably well on these investments. Burry and anyone else can invest in these Chinese companies on the American stock exchanges through what's called an ADR, but that doesn't mitigate some of the risks that come with owning them. The geopolitical tensions between the US and China are no secret, and they're likely going to get worse as China becomes a greater economic power. In particular, as Alibaba has grown into a bigger and bigger global business empire, it's faced increased regulatory pressure from its government. These are some fairly important wildcards that could affect how these businesses are allowed to operate, or even if US investors or foreign investors, for example, are even allowed to own those stocks. But what about this huge piece of Burry's portfolio? It's over $80 million. Well, about 42% of Burry's portfolio is just simply unknown to us. We know that it's unknown to us because there's another filing called an AVD, which shows us the total assets under management, but we don't get to see what it is. It could be real estate. Burry has spoken about buying farmland in earlier interviews, but it could also include commodities held directly. It could include short positions, so where he's betting that a stock will go down, and it also, of course, could include cash. If you want to see more portfolio breakdowns, then make sure you let me know in the comments section below and subscribe for free if you'd like to see my future videos.